Joining us now to discuss BTC price and more is Kyle Waters, research analyst at Coinmetrics. They just released a very special report on Bitcoin. Hi, Kyle. Thanks for joining us. So just taking a look at Bitcoin,
Hi, Christine. Thanks for having me.
Great to have you. It has been a very narrow trading range, pretty predictable. And I'm just wondering your thoughts on what is moving Bitcoin.
Yeah, sure. Yeah, thanks again for having me. Yeah, so as you just showed here with the volatility chart, the markets have been a little bit subdued recently. I think in terms of the markets, we've seen volume that's been pretty low, and I think some of the hype has kind of died down. We've just seen a little bit lower kind of spikiness in the price candles. So I think what's kind of driving the market right now is a lot of people are kind of taking a look at the technology stack and kind of looking a little bit more at kind of the user adoption and taking more of a look at kind of the fundamentals, which we looked at in our report this week, taking a step back a little bit.
So we have a few charts from your report, and this one I wanted to bring up was Bitcoin's realized market cap, which stands at about $465 billion today. And this is one of Coinmetrics' flagship metrics. So walk us through what we're seeing here and how it could be useful.
Yeah, sure. Thanks. So just in the red here is just a very familiar chart. So that's just Bitcoin price. But in the green here is our realized cap. So realized cap is a spin on market cap that takes into account basically the richness of the Bitcoin ledger that we can see when each coin last moved on chain. So what we do is in a traditional market cap metric, you take the current supply times the current price. But with realized cap, we take the price at the time each coin last moved on chain. So this discounts coins that were last moved very long ago when price was much lower. And so for realized cap to go up, then those coins had to have moved in a higher price environment. So what we can see for realized cap, when it kind of more than doubled in 2021 to 2022, a lot of new coins were revived in that period, making realized cap go up. But at the same time, for realized cap to go down, people have to move coins at a lower price than when they last moved on chain. So the fact that realized cap hasn't really come down say it's in the last 6 months or so when we had our last all-time high in November, shows that there's pretty good holding behavior. And actually you can see that as well on chain that, more than half of supply hasn't moved in over a year. This again signals to most user behavior and holding behavior.
Interesting. We also have one chart on block fullness and fees are down. Why is that?
Yeah. So this has been a conundrum that Bitcoin community and the crypto research community has been discussing. And there are some really interesting theories here. And I'd like to point to a great report that Galaxy Digital, some of my peers in the crypto research space, put out. And they put out some really compelling reasons and theories behind this. And so they can be broken down into a few different categories. So first, the composition of transactions has really changed on chain. And so one thing that's changed is Tether. So Tether, the stablecoin, was issued on Omni, a platform that settles up on the Bitcoin blockchain. And so Tether, as it's kind of moved across to it started on this Omni blockchain. It's moved across to Ethereum, to Tron, Solana, many other blockchains now. It is being used less and less so on Omni, so that means less transactions that are being settled up onto the base Bitcoin layer. Also, more exchanges are using something called transaction batching as well, that there's more evidence of that. And so basically instead of sending, we say if you're a user and you withdraw Bitcoin to your account, instead of just one single transaction that the exchange sends to you, you might be included in 100 other people will be getting their Bitcoin in the same transaction. So it's this grouping of transactions and it's more efficient. So it's kind of more efficient block space use. And also kind of better technology as well. So Lightning Network, this layer 2 scaling technology is being adopted more, and we're seeing that just means less small payments settled on the base blockchain layer.
So we're seeing fees are down. At the same time, we've got this Bitcoin activity heat map, if you will, and things are looking pretty hot.
Yeah, so this analysis here is looking at when Bitcoin is used during the day on average. And so on the y-axis here is the hour of the day, and this is in UTC. And so the 2 p.m. to like 8 p.m. period in UTC basically overlaps with US market hours. And so basically since end of July, October, we've seen a pretty big shift of activity. The density of activity is more clustered in this US market hours window. And that also goes along with the crackdown in China where crypto was basically Bitcoin mining was banned, and that also led to just a broader kind of exodus of activity out of the region. So
you can see most of this activity is or do you think people are using Bitcoin for payments?
Yeah, it's tough to say that the actual composition. Like I said, I think for payments, a lot of that is just better on just layer 2. So we've seen Lightning Network. If you're doing kind of micro transactions, it's just better to do that on a kind of like a deferred settlement basis. But a lot of it, is probably exchange related. A lot of US based exchanges kind of conducting their operations during US business hours, which makes sense. Potentially other kind of large US and US or Western, generally based institutions getting involved.
We also have just this last chart, which is daily active BTC wallets, which is looking pretty steady, but the number of wallets out there is accelerating.
Yeah. So this is a metric that we've devised. So this we count a wallet as a different entity than an address. So a wallet is a group of addresses that we've clustered together using blockchain data analysis, and so what you can tell here is, so it basically accounts if one person or one entity has multiple addresses, we can track that single wallet or group of addresses. So although active wallets has come down a little bit from at the beginning of 2021, it's held steady, and also the number of wallets has begun to increase after being a little bit flat for the second half of 2021 has started to accelerate and is pretty close to 40 million wallets now that we can see on chain.